Not one property market, but many. The Great Split is already underway. Hello and welcome to the iStrategic Weekly Insight for the 1st of May. Here's a stat that caught my attention this week. According to Cotality data, national median property values increased by $19,530 over the first 3 months of 2026. Now that's $217 a day, $1,519 a week, and $6,510 a month. That's roughly $79,000 annualized. Now, on face value, that's a strong result and demonstrates the importance of owning real estate if you want to grow your wealth. But to me, it also raises an important question, which is, where is that growth actually happening? Because in reality, there's no such thing as the Australian property market, but rather there's hundreds of markets around the country and all often moving differently. And right now, what we're seeing is a very, very clear and growing divergence, which is what I'm going to talk about today. So the big trend is market divergence. Some markets are performing very strongly, others are flat or even declining, as you'll see in the mainstream media, because they're jumping on the doom and gloom bandwagon as predictably as ever. So that gap is widening. From what I'm seeing, both in the data and the deals I'm doing with my clients on the ground, there are two major trends emerging. The first is affordable markets are outperforming. So if you look at higher end markets, particularly in cities like Sydney or Melbourne, there have generally been price declines in those top tier or higher quartile markets. And that has dragged down the overall headline median price in those two cities. Meanwhile, lower price points, more affordable suburbs and entry-level housing are holding up much better. And in many cases, they're outperforming. In fact, in Sydney and Melbourne right now, there are some suburbs that are growing between 9 and 15% in the last 12 months, even though and even while the headline median price in those cities has been sliding backwards. So why is this happening? Well, there's a few key drivers. One is increased demand from first home buyers, another is affordability constraints, and another is higher interest rates, which are reducing borrowing capacity. In simple terms, people are trading down according to what they can afford. This is something I've seen play out consistently over the past 12 months. Every client I've worked with recently has either bought in a more affordable segment or focused on markets where demand is strongest at lower price points. And as a strategy, it's been working. Number two trend is that regional markets are leading. So in aggregate, regional markets continue to outperform capital city markets in both capital growth and rental yields. Again, this is something I've seen firsthand with my clients. Over the past year, the purchases I've been involved in have been either regional locations or affordable pockets within capital cities. And in all cases, those markets have delivered strong price growth, strong rental increases, and very low vacancy rates. So why the regions? Well, there's a few structural reasons. One is ongoing migration out of capital cities, or net migration, internal migration rather. And this is due to a lifestyle shift. So flexible work hours, lower commute times, nicer fresh air, all that sort of thing. And of course, significantly more affordable housing in the regions. According to Michael Matusik, families and midlifers aged between 45 and 64 are leading the charge. Young adults, 25 to 44, are also moving out, but 14 to 24-year-olds are staying in the city. Now, this matters because it tells you that migration isn't random, rather it's economic and life cycle driven. Work, housing cost, and lifestyle. For many buyers, it's a simple equation. Better lifestyle plus lower cost equals strong demand. To bring these two trends to life, here's what we're seeing in the latest Cotality data. In Sydney, while overall values are 1% below their late 2025 peak, more affordable outer ring areas like Penrith, St Mary's and Mount Druitt have recorded double-digit growth. In Melbourne, values in aggregate are 2.3% below their 2022 peak, but suburbs like Frankston have seen around 9% growth in the same time, so a clear divergence. In Brisbane, growth corridors like Logan in the south, Ipswich in the west, Moreton Bay in the north have recorded 20% plus in annual growth in many of their suburbs. While in regional Victoria, markets like Bendigo, Ballarat and Wodonga have delivered strong growth at much lower price points, like between that $500,000 to $600,000 mark. So what this tells us is you can't rely on broad market assumptions anymore. It's no longer buy anywhere and it will go up. Instead, it's about the right location, the right price point, and the right product type. Now, there are still areas that carry risk. There always will be. For example, Melbourne is becoming attractive for investors from a value perspective, but in my view, it may still be early in its recovery cycle. There are still a lot of underperforming suburbs in and around Melbourne and a lot of suburbs that have rental oversupply. So be careful there. That could mean, if you're buying there, a period of slower or flat growth before things pick up. So patience and timing and asset selection are going to be really important. Okay, so the big takeaway this week is simple. The market hasn't stopped, it's just becoming more selective. We're seeing strong performance in affordable segments, continued demand in regional markets, and clear divergence across locations, price points, and product type. From my perspective, this is where good data, careful selection, and a clear strategy will make all the difference. If you'd like a deeper breakdown of the specific markets I'm watching, including the data behind them, feel free to reach out. That's all from me. Thanks for listening and have a great week.